Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, owner of Shepherd Wealth Management. Very excited to be here today on Tuesday, October 4th in studios. Ezra, how was your weekend? And welcome back.
Yeah, good to be back. Weekend was lovely. You know, had some great weather up here in the northern Kentucky, greater Cincinnati area.
No doubt. It was very nice.
How about your weekend?
It was great. Got the weekend started early with a Bengals victory on Thursday night. So
yeah, that felt nice.
It always is a better weekend when that happens. And I don't think we got a chance to talk about this before the studio, so I'll just go ahead and do it now real quick. I had a friend of mine text me late on Friday night. This is like 10 o'clock at night.
Yeah.
And he's like, hey, man, I know some friends. I'm from Ann Arbor, Michigan, and one of my friends happened to come across some box tickets to go watch the Detroit Tigers take on the Minnesota Twins. Do you want to go tomorrow? Like, this is at 10 o'clock at night on Friday. It's like, you want to go tomorrow? Like, we're going to have to leave at 9 o'clock in the morning. It's a 4-hour drive. Yeah. We're going to get up there, hang out, and we're actually going to come back that same night.
Oh, wow.
So didn't get back till 4 a.m. But they won. It was a super cool experience. Got to sit in a box. So that happened. And then Sunday was like a complete recovery day for me because I got very little to no sleep. Yeah. So that was my weekend. But yeah.
That's pretty awesome. I love going to see live baseball. I've not been to too many stadiums. I mean, Reds, caught an Orioles game, and White Sox, those stadiums. I have probably illegally walked around the Padres Stadium once. I had a couple hours to kill before I was going down to Mexico. So,
yeah, it's good stuff, man. That was my third Major League Baseball stadium I actually got to go in and watch a game for. So that's one of the bucket list items that I have is to actually go see all Major League Baseball stadiums.
Oh, that'd be cool.
Very cool, right?
I would love that. I feel that way about the NBA too.
Yeah,
and going to see all the basketball arenas.
Just by the way, I've never been in the Detroit other than the airport. They're revitalizing the city. Very cool spot for sports because they got all the stadiums right there. Like you can see Ford Field, which is where the Lions play, directly across the street.
Yeah.
Like they're neighbors. Then you got the Comerica Park, which is where the Tigers play.
Okay.
And then directly across the street, just a block over, is where the Red Wings and the Detroit Pistons play in the Little Caesars Arena. So it's a very cool experience, although Detroit has a long way to go to get back to where they were from the heyday of that city.
Yeah.
And there are definitely, some areas of that city that aren't exactly as comfortable to walk through, but had a blast, very cool. And that was the weekend for me. And it started out the work week yesterday, of course, Monday, being the very first day of the new quarter here. So we're in Q4. I've been calling for it all year long.
That's my favorite Q.
It is Q4 because historically it's the best performing quarter of the market in general.
Yeah.
Not in every year.
New Year's right around the corner. Q1's coming, and that's always a lot of hope.
Yeah. Yeah. And I'll talk about that today as well. So we got all kinds of fun stuff today. I cannot wait to get into this show. Really cool, big data energy coming out. I wish we could get everyone watching that's going to listen to this actually in the studio to feel the excitement that I have, because all year long, what have we talked about? Yes, we're in a bear market. Yes, there's a lot of problems. However, what history has to say about this bear market is all bear markets end, and there will be a recovery. I don't know if this month and this quarter is I don't know if we've already seen the bottom and this is the next run of a bull market, but what history has to say, and I've talked about this all year long, the average bear market lasts about 289 days roughly.
What day are we in now?
Well, that's about 9.6 months, so we're already past that.
Yeah, so it's time for that bear to
I've kind of talked about October being the bear killer month all year long, and so far so good, but we're only a day and a half into it. So I don't get to say I told you so yet.
Yeah, we're not popping bottles.
Not yet, but they're on ice.
But they're feeling good about it.
We'll see what happens here. So very excited today. We already had some really good news come out here. We got some jobs information as far as job openings, and job openings fell by 1 million job openings, which is less than what economists had expect. That's actually good news because Jerome Powell, his whole mandate on fighting inflation is crushing demand. And the most effective way to do that by increasing interest rates or slowing economic growth, which would slow hiring. So essentially the Fed has come out and said, hey, we want some people to lose their jobs. not too many people, but we definitely want some people to lose their jobs. And we want to slow the growth of the U.S. economy. And although it's not fun to root for anybody to lose their job or for companies to slow down hiring or to root for a slowing economy, none of those things I am a fan of rooting for. But if you are a long-term investor and you've dealt with the pain that we've went through for 9 straight months this year, you're going to take anything that you can get in the short run. But long-term wise, I don't think anybody would ever want to root for a slowing economy, slowing of hiring, and anybody losing their jobs. But the Fed's come out, many, many times and said, hey, this is what we're looking forward to. But they got some of that information from the jobs data today. We're going to get more employment data as we go through the week. Friday's a big day where we're going to get, unemployment information. We're going to get ADP reports as far as, new hiring that happened.
Yeah.
So if we get a lighter number than what economists expect, that should continue the stock market rally. And next week, the second week of October, we get the kickoff earnings season. So basically going to see corporate earnings for approximately another month and a half after that. So we'll have all kinds of fun stuff to talk about and to react to and respond to. And I'm sure we're going to get a lot of your questions as a result of all that.
Text line's already blowing up with some familiar callers or texters as well as some new voices. So
great. Well, we'll make sure that we get to all of that. So I do a monthly newsletter for all my clients. And obviously we're in a new month, so everybody got a newsletter from me yesterday. I sent it out a little later than I would typically do, just simply because I wanted to get all this data in a succinct format that people would be able to digest and understand and read it very comfortably and easily. So let's start out with the bad stuff.
Okay.
First of all.
Yeah.
So the S&P 500, the NASDAQ were down 10% for September. Dow Jones was off 9.2% for the month of September. Dow Jones was down 21% year-to-date as of the end of September. S&P negative 25%, and NASDAQ declined 33% year-to-date as of, again, the end of September. None of the three major averages in the United States have finished a year down more than 10% since 2008. Wow. So we're kind of, at least as of the end of September, definitely on track for that. The September sell-off was largely attributed to, as we already know, escalating fears of the Federal Reserve continuing to rise rates. In all 11 sectors for the month of September, including energy, which we've talked about has been the only positive sector year-to-date, but all 11 sectors for the month of September were negative. Now, here's the most interesting statistic so far for the show, right? We're only 8 minutes in. I got a lot more to get to. So
let's do it.
This is the first time in approximately 80 years, right? 80 years, roughly, that we've had in one quarter. So we're talking about Q3.
Okay.
Right? So we got July, August, September.
Yeah.
It's Q3.
All right.
So June was the low of the year prior to what we just saw as a sell-off. So I'm going to get to that.
Okay.
But we had a big sell-off. At that time, we saw the market bottom in June, and then we got a rally, right? Basically from July through mid-August. Super cool. At that time, we were up approximately 14% across the major averages, which is great. We're basically getting back almost half of the losses that we've experienced.
That feels nice.
So everybody that's watching this and listening to this, you should keep in mind, yes, the pain of watching the market fall day in, day out, week in, week out, month over month, it does not feel good. But we got half of those losses back in 3 or 4 weeks. So markets recover rapidly, and they typically recover much more violently than they do on this very slow, painful way on the way down. So just keep that in the back of your mind. But here's the stat. First time in approximately 80 years that we've had intra-quarter, all of the major averages up that much, then actually finish the quarter with all the major averages heavily in the red. Right? We just went over the NASDAQ, the S&P down 10%. And, it's the first time we've seen anything like that in 80 years. So this is just the beginning. This is the tip of the iceberg of the data that we're about to drop on people today.
I just have to start by saying, go big or go home. I mean, if you're gonna lose it, blow it up.
Well, we have a game plan for that to make sure that our clients and investors go about this in a risk-appropriate way. But you're right. I mean, being in the market is so much better than trying to time the market.
I mean, I feel like the last few happy hours, even the last several episodes of the podcast we've done, you've brought that data in about how just missing, a handful of days out of the market
It's like you saw my notes before we got started here today, Ez, but I know that you didn't. So, but you're actually taking, you're putting the cart before my horse here.
Excuse me then. Let's go. Let's go.
Now, so why is that? So the Fed has already increased interest rates by 300 basis points and is likely going to do more. And the market's pricing in, if you look at the interest rates on bonds and so forth, I think the consensus expectation, and obviously all this stuff can change based on data that we're going to get this month, from jobs to unemployment rate to new inflation data coming out on October the 13th. Plus, we're going to get a whole bunch of earnings, like I just mentioned. So everything I'm about to say obviously could change. But the Fed's already increased rates 300 basis points, likely going to do more. Why is that? Because we have 40-year high inflation. We have an energy crisis over in Europe, obviously a war, and bearish sentiment for Q3 exploded. And I sent out a chart to all my clients within the monthly newsletter. But essentially, the bears doubled down on their bearishness going from Q3 or from Q2 into Q3. Now, why is that important information to know? Because if you're a long-term investor, meaning at least 5 years or greater before you really need to start tapping into a significant percentage of your, let's call it retirement assets or your savings in general, keep in mind, if you need to make money in the market over any 90-day period of time, it's probably going to be a very difficult situation for you, regardless of the year that you're in. So if you're a long-term investor, this is helpful information to know, because, I have a lot of other cool data to share, but wouldn't you want to be a buyer of an asset class like equities when everybody else is so bearish on them? And I think the obvious answer to that is yes, and you have no other place to turn to other than the greatest investor of our generation.
Who is that?
A guy named Mr. Warren Buffett.
Never heard of him.
And, some people haven't, but I would say that the vast majority of folks definitely do know who he is.
Well, he is the unofficial spirit animal. He hasn't actually agreed to that licensing, but he is the unofficial spirit animal of Shepherd Wealth Management.
We should tag him in one of our posts just to see if that
bring him on. See if he'll come on the show.
I mean, that would be super cool. I have so many books that he could sign, like all of them. I have all of the books that he ever did. But the reason why I bring him up constantly, other than the fact that he's doubled the S&P 500 performance over his entire career,
right?
He has spent more money on new positions or adding to positions that he already owns this year than he's done in probably the last 10 years, roughly, right? And his performance on those purchases in general, as of the end of September, wasn't that good. It was actually pretty bad. But he is looking at the same sort of data that I'm looking at and saying, I am going to be greedy when everybody else is fearful. It's worked out for him for 65 straight years.
It's worked out very well.
So I'm sitting here pounding the table all year long, right? It is not easy. It's counterintuitive to go ahead and put your capital at risk when everybody else, that you're going to be sitting around with at the birthday parties, the barbecues, soon to be Halloween, Thanksgiving, and Christmas, they're probably going to bring some of this information up. And just check out their investors' sentiment, what they're actually saying, and how bearish they're probably positioning themselves, or their tone anyway. But that is absolutely the right time for the long-term investor to either dollar cost average in, as Mr. Buffett is doing, as we're speaking right now. Also gives you great opportunity to rebalance, which we've talked about all year long as well. And the reason why all that's important is because you cannot control what the Federal Reserve is going to do. You have no idea what the future of interest rate environments. There's absolutely zero control over geopolitical events.
Yeah, you can't predict the pandemic.
Right. I mean, you can show up to the polls and vote, but that's about it. I mean, there's so many. We could sit here from now until the next time we do a podcast show a week from today and just talk about all the stuff that individual investors cannot control. But the one thing that you can control, I would actually say two things. One is your asset allocation, that percentage of your money invested in stocks, bonds, and cash. That's something you can control. And the great news about that is, if that is something that you can always control, that's where 94% of the variability of performance is going to come from over a long period of time. Check that box off. We got control over that. And the other thing that we can control is our temperament. So how do we go about doing that? Well, you do that the same way that Mr. Buffett has done it, the hard way for 65 plus years, which is I'm going to do my homework. I'm going to get information about what's going on right now. And then I'm going to look back and say, what does history have to say about similar points in time? Because inevitably, the market is made up of a whole bunch of human beings. And what do we know about human beings, Ez?
Well,
they tend to not learn from history, right? Right? I mean, that's just the truth.
Yes.
Why is that? Well, like we've talked about all year long, we are human beings. We're all hardwired with fear and greed, going back to caveman days. Mr. Buffett understands this, right? If we're hardwired with fear and greed, well, what we've learned from that over the course of history, and thanks to the study of behavioral finance and folks like Richard Thaler and others, is that humans feel losses, like they feel them mentally and emotionally twice as much as they feel good about their gains.
Thank goblins, I'm not the only one who does that.
Yeah. So if we know that and everybody else is getting super bearish, that typically provides us a great opportunity to own an asset class like stocks because of their long-term track record of, hey, when the markets fall, there's always been a recovery, and the recovery has been substantially better than the downfall, even though it will not feel like that at that particular moment in time. Now, that's the reason why I have a job. So, again, we're just getting down the tip of the iceberg here, 16 minutes into the show. Now we're really about to have some fun. Let's talk about this asset allocation thing.
Let's do it.
All right. So,
let's break it wide open.
I'm a certified financial planner, and I've been one for a while. I've worked with a lot of clients at very large firms. And like I talked about, one of the very most important things about long-term investing that you can take control over is your asset allocation.
Right.
So how do we figure out what's the right asset allocation? Well, it's just a conversation that we have with individuals, right? Because not everybody's going to want to have the same asset allocation, right? Your asset allocation should be dramatically different than, let's say, your dad's, right?
Yeah.
He's in the 70s.
Tom, yeah.
Yeah. So easy enough based on age and time frame is really what we're talking about here.
Right.
So it's one aspect. All right. So what's your time frame? What's your time horizon? You know, showing historical performance of different asset classes will give you an idea of how comfortable folks are with volatility and risk within a portfolio. The actual goal that they have for the money, is it to support the lifestyle that they have? Is it to leave a legacy? Charity, take care of any unforeseen things that could come up throughout, potentially long retirement, because people are living about as long in retirement on average as they are when they're working, which could be, 30, 40 years. Mm-hmm. So maybe you're just saving and investing for the inevitable thing that you can't plan for today. It could be a health related thing or whatever the thing may be. So these are the conversations that we're going to have with individual clients to define an asset allocation. History would say that the most recommended asset allocation from advisors to those close to retirement and those in retirement is a 60% stock, 40% fixed income asset allocation. Classic 60-40 portfolio has been recommended for decades, way before I've been around. So why are we talking about it this year? Well, this year has been everything but traditional and normal.
Yeah.
And if you knew nothing, right? This is my point, is if you woke up on September 29th,
right,
and you knew nothing about the geopolitical stuff going on in Ukraine, you knew nothing about, what the Fed was doing with interest rates, you had no idea that we had 40-year high inflation, you were just like under a rock or in a coma, somebody woke you up, and you have your money invested in the marketplace in a 60-40 portfolio because it's classically
that's what you've always been doing.
Well, why is that, right? Why would we recommend a 60-40 asset allocation for somebody close to or in retirement? Because it should, based on history, produce a positive portfolio return of approximately 7.5%, 8%, right? And you're typically going to see 25 to 35% less volatility with that type of asset allocation than you would if you just had all of your money in stocks, right? That's why it's recommended. You're getting, so if the market averages, let's say 10% over the last 100 years, and you have a 60-40 portfolio where you're roughly getting 80% of the market's growth, and you're taking, call it 30% less risk approximately, that's a pretty good risk-reward trade-off. That's why it's been so heavily recommended by advisors for, like I said, decades upon decades. This is not one of those years, and I'm about to share that with you as to why that is. So if we look at a 60-40 asset allocation over the last 100 years, right? So we have a very large sample size here. This has been the second worst performance as of September 29th, 2022 for a 60-40 asset allocation, the second worst nominal performance for that portfolio in the last 100 years. The only time it was worse. So by the way, that 60-40 portfolio, again, as of September 29th of this year, is off by 20+%. The only time it was worse than that was during the Great Depression, 1931 and 1937. Now, if you take inflation into account, right, these are nominal returns.
Okay.
What I like to do when I'm doing something like a retirement plan for a client is look at real returns, saying, yeah, this is what we're striving for nominally, but we have to factor in inflation also. And we might have to factor in taxes too if you're taking out a regular distribution, let's say a required minimum distribution from something like an IRA. So what is the actual real return, and project that out over a long period of time. So real returns matter. If you look at real returns, which is factoring in inflation in this context, not taxes, but just inflation, this is the worst year in the history of all years for a 60-40 portfolio. Being down 26% if you factor in inflation. There has been no other time in the last 100 years where you saw worse results for a 60-40 portfolio.
Wow. I mean, go big or go home.
Now, let's talk about why that is, because I guarantee you the majority of people that are watching this that are in retirement or they've worked with an advisor, they're close to or in retirement, I bet you, I can't say this across the board, so all the regulators out there that might watch this show, it's not 100% of people watching and listening, but a big majority of you probably had somebody say, hey, 60-40 asset allocation.
Way to go.
Way to go.
Yeah.
Great. History is on your side, by the way, when you make that recommendation. It was just a poor recommendation to make. And you want to know the thing about working with large financial institutions, right? Shepherd Wealth Management is not one of those. We custody accounts at a large institution called Charles Schwab, right? They are the custodian of all these accounts,
right?
Meaning that clients don't send me money. They send the money to Charles Schwab, whether it's electronically transferring securities or just depositing money to the account. So I have no custody of those assets. I can just see what's going on there. But when you're getting advice from large financial institutions, I mean, think the biggest of the big across the globe, really.
Yeah.
Right? What do they do? And I've talked about this, I don't know how many times. They're going to have you fill out a suitability questionnaire. We already kind of talked about what some of those questions are going to be, right? Goals, risk tolerance, time frame, et cetera. And depending on how you score on that, let's say you score a 70 on a scale of 0 to 100 from a suitability standpoint. Well, Ezra, you just got the exact same portfolio as everybody else that scored a 70.
Yes.
You know what that means is, okay, 60% stock. Well, maybe 50% of that is going to be diversified across the United States. 10% of that is going to be in international, let's say.
Okay.
And then that 40% in fixed income, maybe like 35% of that is going to be diversified across different types of fixed income, both short, intermediate, and long duration, and a little bit of cash, right? That's your asset allocation, 60-40. And you and everybody else are holding the same positions, essentially, at the same firm. Let's say you and a million other people are investing at XYZ large financial institution. Mm-hmm. Now they're doing that large institution is doing that to strip out the individual advisor risk. And this is what we've talked about all year long. If I am a certified financial planner and the guy sitting over here behind me in this other office is also a certified financial planner, and you walk into my office and somebody else with the exact same goals, time frame, and risk tolerance walks into my neighbor's office and we're still working at the exact same firm, you guys got the exact same asset allocation. Well, what if I was able to actually pick individual positions that was more tailored to the time that we're in, right? Rising rate environment, terrible for bonds. You have an energy crisis going on, and actually leading into the year before we even had the war going on in Ukraine, there was all kinds of issues from an energy standpoint across the globe, specifically in countries like Asia, Europe, and other places, Latin America. It was probably not the best idea to own those asset classes. So here at Shepherd Wealth Management, we stripped out international. We stripped out all fixed income, right? Because of those reasons. And performance for clients has been so much better than the overall market, and certainly better than a 60-40 asset allocation this year because we made that decision. Mm-hmm. Now performance is better. Now my friend next door to me, built that 60-40 portfolio, and the performance was so much worse. But remember, you have the exact same goals, risk tolerance, and time frame as the person that built the portfolio for my neighbor here.
Right.
Because these big firms, they strip out the individual advisor risk of making their own investment decisions, because in this example, that big firm just got a lawsuit, right? Because somebody with the same goals, time frame, and risk tolerance had a custom portfolio that did better for them than my neighbor just stuck with the classic asset allocation mix regardless of what's going on. So they just got sued. So we can see that in the numbers here. We cannot just say as advisors, and I'm speaking to people that are like me. They're advisors, they have experience, they maybe have, certified financial planning designation, maybe they went to graduate school, got an MBA, and all the things that clients like to be able to see on your resume before they decide to work with you and do a retirement plan and have you invest their money for them. You cannot, as an advisor, just blindly say everybody that scores the exact same on a suitability question should always have the exact same asset allocation, or they should always have, blindly X percentage in all of these asset classes. Yes, history is on your side, but what do the regulators want me to say every time I start talking about things like performance or risk and all this other stuff? Past performance is no guarantee of future results.
Yeah, because it's not.
It's not. They're 100% right, but what are the big firms doing? They're just saying, oh yeah, history says this about all this stuff, and they're right. They are right. I would love to have international exposure. Now maybe we can start to consider fixed income as an asset class for clients now, because we're getting closer and closer to peak rates based on what the Federal Reserve is going to do. And these are conversations I'm having with clients in real time. But leading into this year, that was a dumbass idea to own fixed income and international, right? And those institutions, I love all the places I've worked. I got friends at all the places that you guys have heard of, that you might be thinking of right now. They're not wrong with the asset allocation recommendation. But leading into a year like this, they are wrong to assume that this is in the best interest of clients right now, right? Because of all the things that are happening around the world, which is just not the case.
Right.
And that's unfortunate, but that gives us a competitive advantage here. We get to be a little bit more nimble. And now that we're getting closer and closer to peak rates, we're going to go through a winter season, which is unfortunately going to hurt a lot of folks over there in Europe.
It's going to be horrible.
They're going to go through a recession, and that writing's been on the wall for a long time. It wasn't like this is all of a sudden, now we know that they're going to go through a hard winter. This has been writing on the wall for quarter after quarter. It was actually pretty evident to me at the beginning of the year, before we even had the war going on in Ukraine, that kind of exacerbated things. So that gives us an advantage as a smaller institution. Again, we get to use all the same technology. I got the exact same retirement planning software that we used, at pretty much every major financial institution. We get to use all the stuff that Charles Schwab has available to us. Like, I have all the same resources. I just don't have the, let's call it the big brother, if you will, kind of looking over your shoulder, telling you how to make a decision that's in the best interest for clients, when in reality, at least in this instance, in this market year, was definitely not in the best interest for clients. And it's not even arguable, right? You cannot argue the data here. The worst in the last 100 years for 60-40 portfolio. I mean, come on.
That's you can't not notice that.
It's unfortunate.
It's unfortunate and huge.
It is. So I know we got some questions coming up here, and I've been letting it rip for 28 minutes. I'm not even done.
So now keep going. We still have some time slotted for the rant.
And I told everybody leading into this, I said it last happy hour. You got to watch Tuesday. I'm coming in hot, and here we go. Yeah. So now the next thing is this midterm election, right?
Yes.
Everybody's seeing all the commercials. Freaking hate these political commercials, man. It'd be cool. You know what? I'm not going to run because it's just annoying, everything about politics.
You would be
I have my opinions.
Excellent leader.
But, and the truth is, probably the people that would be the best at it don't want to do it because of the stuff that you kind of see on the commercials. I think it would be super cool if we had a candidate, I don't care what party, whether they're running for Congress, Senate, the House, freaking president, it doesn't matter. It'd be really cool if somebody came out with their commercial and said, you know what, I know I'm running against Joe Smo or Sally, whoever. I'm not going to say anything negative about them. This is what I believe in. This is what I'm about. This is what I plan to do. This is why it's important to me. And they can say whatever they want to say about me. But if you like what you're hearing, vote for me. How cool would that be?
That would be cool.
Instead of seeing people like throwing footballs at TVs and like
gets back to your fear and greed thing though, that kind of runs
against the current of what the news
best interest of everyone
exactly
is not fear and greed.
I digress. But we do have to talk about performance when it comes to investing in a midterm election year. So the recent pullback in the market should come as no surprise based on what history has to say for midterm elections, right? Oftentimes, there's elevated volatility during election season.
Yeah.
Shouldn't be a surprise. The average intra-year market correction is 17% for the S&P 500. Now, we're more than that. As of the end of September, I rattled off the numbers there. I think we were down like 22% roughly in the S&P 500. But that's not all that far away from the average return of the S&P 500 in a midterm election year. However, again, we're looking at history, and I'm going to disclose it again. Past performance is no guarantee of future results. But, again, human beings don't learn from history. Otherwise, we wouldn't have a history class every single year all the way throughout school until you get to college unless you're a history major.
Right.
Tends to repeat itself, unfortunately, and we do a terrible job of learning from history, which is a big reason why I'm doing this show, is because you do need to learn from history. And here's what history has to say. First of all, shouldn't be that surprised, elevated volatility in a midterm election year. I just rattled off that information. Investors who stay the course through the pre-midterm drawdowns are often rewarded via substantial rally in equities. The average one-year performance post-correction of the S&P 500 has been 32%.
That's not too bad.
It's not too bad, right? Additionally, 78% of the stock market's best days occur during a bear market and also occur during the first 2 months of a bull market. And you won't know it's a bull market until several months after that.
Until everybody's calling it a bull market because they got several data points to check out.
78% of stock market's best days occur during a bear market. So, although I felt this too, I've actually talked about this with you and a few others. I'm like, man, based on everything that you're seeing, this is going back to like, April, May, June, where it's just, you're just getting hit in the head with terrible news, terrible market performance, just quarter after quarter. And I'm looking at it logically and saying, I can make a very strong argument that I should probably just take everybody to cash for a period of time here. Mm-hmm. But when you start to look at what history has to say about this, you do not know when that bull market gets started, right? And you can miss out on some of the best days of all time. And the problem with that is if you miss the best 10 days in the market over the last 30 years, your returns get cut in half.
Here it is, that BDE.
Yeah. Big data energy. So
cut in half.
I feel the same things that people feel. I am a human being. I have fear and greed inside of me as well, just as everyone else does. This is why. This is the only way that I can control my temperament. Maybe some other folks can control their temperament by not doing this historical research. Maybe they're better off, hitting a punching bag or going on a 50-mile run or something.
Yeah.
I'm not saying don't do those things, because I'll do that on occasion.
Yeah. Well, I know you, so I don't have to do it.
Exactly. But I will go to this kind of data, and this is how I get control over those internal emotions. That's how I get control over my temperament. I mean, that's crazy. Missing 10 days in 30 years, you'd think, oh, shoot, man, what is your return difference? Maybe like a couple percentage points? No, it gets cut in half. And if you miss 30 of the best days of the market in the last 30 years, your return gets cut by an astonishing 83%.
Oh, got to have that 83% though.
So we're talking about, like we talked about at the very beginning, like we talked about all year long, time in the market is so much more valuable than trying to time the market.
Yes, 100%.
You should be rebalancing. You should be doing tax loss harvesting, if you haven't done it already this year. You should be rebalancing a portfolio. I mean, you should have diversification, not have everything all in one basket. And as I mentioned, having a good asset allocation makes a ton of sense. Just don't be blind to the facts of what's going on, because you can always go, like what we're going to do for clients here sometime beginning part of next year, is we will end up adding international exposure because it's going to be at a super depressed price level, probably coming out of the wintertime.
Yeah.
I don't know when they're going to recover. I don't know how long it's going to last. Could take more than a few months, could take years. But I know that I'm going to get a substantial value for the price that I'm going to pay for those shares at some point. I can say the exact same thing about fixed income. And you can say that about almost every asset class outside of energy, for a long-term investor, you're probably going to get a pretty substantial value for those investments that you're making if you are dollar cost averaging, if you are rebalancing. So there's some pretty important statistics that I wanted to share with everybody, and I got just a couple more here. All right,
let's do it.
This has been a roller coaster ride of statistics I'm slapping everybody in the face with, but you need to hear this.
Yes, we do.
All right, so stocks lose 36% on average in a bear market. We haven't even hit that yet, so it is quite possible. If we go through the earnings season that we're about to go through here, and we have super sticky inflations, inflation staying high, and earnings are awful.
Yeah.
Well, history would say that we might have a little bit more further downside risk to go. However, there's always good news. By contrast, stocks gain 114% on average during a bull market. Bear markets, there's been 26 of them in the S&P 500 index since 1928, but there's also been 27 bull markets. Bear markets are short-lived. The average bear market length is 289 days. We talked about that. That's approximately 9.6 months, and thank God we're in October. We're past the 9.6 months.
Yeah, we are.
All right? And that's significantly shorter than the average length of a bull market, which lasts, so average bull market, just take a guess. What do you think?
3 years.
Yeah, there you go. Maybe it's because we spent so much time together here on the show. But the average bull market lasts about 991 days, or about 2.7 years. And let's see here. What else we got? We've talked about half of the S&P index strongest days in the last 20 years occurred during a bear market. Another 34% of the market's best days took place in the first 2 months of a bull market before it was clear there was a bull market. And of course, bear markets are painful, obviously, but overall markets are positive a majority of the time. We talk about this a lot. In the last 92 years of market history, bear markets have comprised only about 20.6 of those years. Put another way, stocks have been on the rise 78% of the time. So I've said this a lot, and this is all based on what history has to say. And again, past performance is no guarantee of future results. I'm just reading you what the actual results have been over 100 years, or in this case, 92 years. And every year that you wake up on January 1st,
right,
as a market participant, let's call it 70% of the time, your money is going to compound, right? It's going to grow. So why would you try to time the market? Because the reality is, when you read this information, the only other ways, maybe there's some other ways that I'm not thinking of right now that's obvious to me. But you could say in the first 9 months of this year, truthfully, the only way, or at least two ways that you could say for certain that you would have had positive or substantial positive performance is if you shorted the whole market, which that would take some serious intestinal fortitude to short the market for 9 straight months. Buffett himself famously said if you bet against the U.S. corporate economy over the last 250 years, that was a terrible bet. But I guess you could have done that. I didn't do that.
Yeah.
Or you could have just put all of your money into energy, because it's been the only sector of the S&P 500 that has positive performance year to date. But that's one of the most volatile asset classes and the smallest sector of the S&P 500 by a wide margin.
Yeah, and it ain't even doing that great.
Yeah, and who would want to be like, oh yeah, as an advisor, I recommend that you short the market for half of your portfolio, and for the other half, put it all into one sector. Like, nobody's going to do that. If you did, congratulations, hats off. You have, substantially outperformed the market. And hopefully, you have the data that I'm looking at here that would suggest that you might want to consider shifting that. But I highly doubt anybody watching and listening to this did either one of those things.
Yeah, well, even with rebalancing and asset allocation in mind, that type of nearsightedness is not really congruent with long-term investing. Mm-hmm. I'm not saying it's a strategy that you should avoid,
right?
But that is more not quite day trading, but it's more akin to something like that.
Yeah, hedge funds will do that.
Yeah,
right?
But again, you have to be highly aware of what is going on to know that you need to be making those calls, because you can't react to something like that. You have to be predictive.
Yeah, and for sure, most of the people,
money.
Yeah, definitely, most of the people probably watching and listening to this, wouldn't qualify asset-wise to work directly with a hedge fund, which is very normal, by the way. Don't beat yourself up about that. But put another way, hedge funds have a historically obvious track record of substantially underperforming the market consistently because of the way that they go about hedging things. And most people are probably in the first camp of, hey, I met with someone, I'm either working with some actively or somebody helped me figure out what the right asset allocation was for me. And again, all those things are good. It probably is the right asset allocation for you, but you just cannot be blind to what's actually happening right now. And I am not a Swami. I can't predict everything accurately. I did not do that this year, but one thing that we did do right, it was pretty obvious that rates are going up. This is bad for bonds, and it was very likely that Europe is going to have a difficult time this year. Yeah. We were right about both of those things. It doesn't mean our asset allocation is wrong. It just gives us more flexibility than being pigeonholed into sticking with a specific asset allocation just because you scored the same as everybody else on that suitability. So with that, it's almost like a mic drop kind of experience here. Let's get to some questions, as I know we got some.
We do. Let's see. So this one's been in the pipe for a while, pretty much since the beginning of the show. Leah from Cincinnati. Anticipating a rally in October. Should I sell into that now?
That's an excellent question. Thought about that this morning a little bit for myself and for clients. Is we've kind of been counting on a rally in October all year long, again, just based on what market history has to say about bear markets. So should you consider doing that? Now, here's what I am going to say, and I'm speaking on behalf of Shepherd Wealth Management clients and the clients I work with. So again, the only reason why I say that is I don't know her specific circumstances and all that.
Yes.
Here's what we're going to do is we have positioned ourselves to overweight things like healthcare, which is a way that you can kind of play offense and defense in a bear market. And by the way, healthcare as a sector is the second best performer, essentially. That and utilities maybe, behind energy, which again, energy is the only one that's positive. So again, healthcare is down about 10% as of the end of September.
That's this year. You don't mean that forever.
Correct. That's just 2022, first 9 months of the year.
Yeah.
So when I say healthcare is a sector that's kind of like offense and defense in a bear market, it's as simple as this. If I go break my arm, I'm still going to the doctor regardless of whether or not we are in a recession.
Yeah.
So you kind of get the best of both worlds there. Now, the sector of healthcare in the first 9 months of the year was down, not nearly as down as the overall market, but there were specific individual equities that had very attractive performance. One of them is United Health Group or United Healthcare, which we have. Another one is the Lockheed Martin, which is a defense company, and of course energy, right, through an ETF or individual stocks, whether that's in the agricultural space, nat gas, oil in general. Those are positions that we are going to rebalance out of. We're going to take profits or very small losses, and we're going to take some of that capital, probably not all of it, because we don't want to just not have exposure to some of those things. Definitely we want to keep some exposure to healthcare and energy, no doubt. But I get to sell into the rally that we're seeing here right now for those asset classes without selling everything and use that capital to buy into things that have substantially underperformed. And the obvious sector to go to there, at least for the long-term investor, would be technology.
Oh, yeah.
It's sold off the most. Right now, in the first couple of days of trading in October, it's the sector that's leading the way. You should expect that. And when we actually do inevitably have the next bull market rally, what is technology? It is embedded in every single sector of the global universe.
Yeah, I mean, you think about life.
Yes.
Any problem we can think of is going to be solved with tech.
Or at least you have to make the investment in tech, right?
Yeah,
you have to have it.
Yeah, you're going to have to have it.
It's the biggest sector. It will remain that way. It is the path forward for the economy. So that's what we're going to do. Yes, we will take some profits off the table at some point in time. I don't know if it'll be this month, but definitely sometime this quarter in those spaces, and add to other sectors that have lagged. So hopefully that helps.
I think it does. Leah, we just want to remind you something that Joshua said at the beginning of the show, which is that the bottles are on ice. They're not popped yet. So we still got to make sure that this rally is a real thing.
It's not just and if it is, we might bring in some aviators and actually pop something here.
Yeah.
Well, we do the happy hour too, so stay tuned to that.
Yeah, stay tuned to that. This is another good question out of Louisville. Claire texts in, how should I prepare for the effect the upcoming midterm elections will have on the market?
Yeah, we just talked about it, right?
We did, yeah.
They're going to be, at least based on what history has to say, should be pretty fruitful. Now, here's what I would say about this a little bit more specifically, because this is a conversation I've had with clients. Yes, history would have to say, based on midterm election years, pretty awesome performance coming out of that midterm election. So you want to stay invested to participate in that. However, you also don't want to be blind to some other facts that history has to say, which we have had an inverted yield curve basically the entire year, right? And what does that tell us? Again, history would say 18 months later, approximately, you're going to have a recession.
Yes, and the fact that that thing has remained inverted for so long.
That and the Fed has a 100% track record of oversteering the economy into a recession every time they go on this rate hike path to slow demand, whether that's fighting inflation or whatever the case may be. The economy's too hot, whatever it is.
They're going to land it on the runway and in the causeway, possibly.
It's very possible. Now, there's a small chance that they could, do what they're calling a soft landing, which is they slow the economy just enough to where it doesn't actually go into a recession. I really hope that happens, but history would have to say otherwise. So don't be blind to these facts either. Yes, midterm election years, history would say you're probably going to get a nice little run. That may or may not happen, but kind of plan for that because it's in the data here. But you can also kind of plan for a potential recession in sometime in 2023, again, based on what history has to say and the moment that we're in right now in this economy. So you have to be prepared for that as well. So what I'm basically saying is don't take this information and say, okay, I'm going to go sell most or all of my energy in healthcare. I'm just going to dump it all in, to one sector or, a couple sectors. You got to have this in the back of your mind too, is how am I going to prepare myself to benefit from the upside that the market might give me based on what history has to say. And at the same time, having a game plan going into Q1 of next year, knowing that history would also indicate that we might have a recession. And recession doesn't mean we're going to go through another 2008, right? It could be a very mild one where things aren't that great for a few months and then all of a sudden we're back off to the next 3-year bull market.
Yeah, well, it's felt like a recession all year.
Exactly.
So I hope it's not worse than that, but you never know till you know.
You never know. So that was hopefully helpful for Claire out in Louisville. As I think we can squeeze in one more if you got one.
We can. I just want to remind Claire that this podcast episode is going to go on to archive on Spotify and on YouTube. So if you missed Joshua's little mini lecture about midterm elections earlier in the show, you can always rewind that in a later date and see what he had to say about midterm elections. All right, so the final question for today, Brian's back from Shelbyville.
Can't do a podcast without Brian, I guess.
Can't do it. It says, Treasury notes at 4%. Should I include that into my portfolio?
Don't know the exact details of the situation here. However, I can say this is a live conversation I'm having with clients where, in general, we would want to have, for a lot of people, a percentage of the portfolio in fixed income. Even if you're the most aggressive investor, it's nice to have an asset class being fixed income that's generally negatively correlated with stocks, right?
Right.
Usually, not this year, but usually, you could say when the stock market's, as volatile as it has been, you could hide out in fixed income, maybe get, some nice attractive percentage. And because inflation's not at a 40-year high, you could actually have a real positive return there and kind of rebalance out of fixed income into equities and vice versa. Like that's usually what we would do. This is not that year, clearly. But this is real conversation I'm having with clients, even for the most aggressive investors. And we can say this, all right, if we can get a 3-month treasury that's paying 3.25%, 3.5%, we can get a corporate bond, like a 1-year high quality corporate bond, pick a very large company, an Apple, a Procter & Gamble, like some company, that has a very much a fortress balance sheet that can actually pay the debt obligation, being the bond. So taking the individual company risk out of the equation, we can now kind of look at interest rate risk and not peg such a high degree of uncertainty there because the Fed's closer to peak interest rates than they are on any other point in time this year, right? The reason why the Fed would either pause or begin to cut rates is they start to see the economic data, specifically inflation, slowing down.
Right.
So if inflation's slowing down because of all the things that they're doing, great, we can get a peak interest rate on a corporate bond, let's call it 5, 5.5, maybe 6% sometime between now and sometime in Q1 of next year. So within the next 6 months, that's likely to be the case, which means if you're getting 5, 6% on these corporate bonds and inflation's coming down below that, now you can say, I have a real positive and nominal return adjusted for inflation. That's great, but you don't want to have buyer's remorse either, depending on your circumstance, right? Because if inflation's coming down and the Fed is now either pausing or cutting rates, that's going to accelerate the stock market.
Right.
So I don't want people to go into it having buyer's remorse and not knowing that really could in fact be the case. Now, you really might love to have that fixed income if we have that mild recession or a severe recession, right? I mean, that'd be nice. We don't know how that's going to play out for certain. But what we do know is if you decide to make that decision for fixed income, do not have buyer's remorse, because as soon as the market does go through that recession and we officially hit that bottom sometime next year, the market's really going to have accelerated growth. And you're going to be like, oh man, I wish I had more of that money exposed to equities. But if you make that fixed income decision as part of your asset allocation, all you're doing is being a disciplined investor. That is a good thing. There's nothing wrong with that. You just have to look at your own circumstance, your own situation, and make that decision with both eyes wide open. And that's why I'm sharing all this information with my clients, as well as the viewers watching, listening to the program here today. So that's a great question. It's real life conversations we're having with folks, and it really should be, that is the right question, by the way. And last but not least, before we wrap up the show, if your advisor is not calling you quarterly, if they've been like hiding under their desk all year long because of how terrible the market's been, and you're not getting these types of conversations, please call us, 513-630-2664. Even if we're not the right place for you, I can show you and point you in the direction of a place that might be super suitable for you. You can certainly call, text us, send us emails about all of that, but they should be proactive in the worst of times, not just in the best of times. So I wanted to get that in there. And last but not least, please don't forget about the money that we're trying to raise. We're trying to raise $20,000 for those affected by the flood down in Hazard, Kentucky. Obviously, I got to spend a full day there. I saw the devastation firsthand. I was part of helping out with that cleanup. And those folks are certainly going to need your support. You can check out the Shepherd Wealth Management YouTube page. You can check out the Shepherd Wealth Management social media page. And if you go to shepherdwm.com, our website, there's links to all of that stuff. We have a link directly to the Appalachian Crisis Fund. Mm-hmm. So we're not collecting any of the money at all.
Going straight there.
It's going straight there to the folks that have boots on the ground. That way they can get that money right into the hands of those that need it the most. So we certainly appreciate your help with that. But Ezra, this was a blast, 52 minutes. It felt like it was 5 minutes. Hopefully those that were watching, listening to this got a lot out of it, and certainly appreciate all of y'all's feedback. I look forward to doing this again on Friday of this week. We'll do the Financial Shepherd Happy Hour.
Yes.
Assuming that I can get the camera to work this time. I tried to do it last Friday when you weren't around, and it didn't work. So we'll give that a shot again.
Get there.
You can catch that right around 4:15 almost every Friday. I say almost because sometimes we're just not available to do that. But around 4:15 almost every Friday, I'm going to do about a 10-minute recap of the markets. What happened? Why did it happen? What can you do about it? And what can you look forward to in the coming weeks? So it's been a blast. Look forward to doing it again. Hope you all have a great rest of your day.